how regulatory and market uncertainty is changing executive risk planning. As 2026 opens, executive decision making is being shaped less by long term ambition and more by short term exposure. Regulatory signals are arriving earlier in planning cycles. Market volatility is proving more persistent than expected, and assumptions that once held across capital, energy, and infrastructure strategies are now being revisited in real time. For senior leadership teams, the issue is no longer whether uncertainty exists, but how quickly it is translating into operational and financial consequences. Uncertainty is no longer a background condition. What has changed is not the presence of regulatory risk, but its immediacy. In the U.S., companies operating under federal environmental programs are contending with shifting enforcement priorities rather than clear rulemaking alone. For example, industrial operators subject to methane and air permitting requirements have seen enforcement guidance evolve faster than permitting frameworks themselves, creating uneven compliance exposure across facilities and regions under the oversight of the Environmental Protection Agency, EPA. At the same time, multinational firms are navigating overlapping disclosure and compliance regimes. European sustainability reporting requirements are already influencing supplier expectations and internal data systems for US-based companies with global operations, even before full enforcement timelines are clear. The result is regulatory sensitivity driven by anticipation, not just enforcement. Regulatory plus market uncertainty is changing risk planning. What leaders are reacting to isn't a single rule, it's the speed at which assumptions break across capital timing, energy exposure, and operational feasibility. What's shifting uncertainty is now an active variable. Planning is no longer set and monitor. Leaders are building flexibility into decisions from day one. Where it hits first, capital timing plus energy exposure. Investments are being stress tested earlier as markets reprice risk ahead of regulatory clarity. What it forces governance plus resilience decisions. Executives are prioritizing optionality, scenario planning, and execution feasibility over single outcome forecasts. Executive takeaways. Risk is being repriced early. Counterparties, insurers, and markets are reacting before rules fully settle. Operational constraints are strategic. Grid capacity, permitting, and infrastructure readiness can dictate timelines. Optionality is the new advantage. Phased investments and diversified procurement reduce downside exposure. Capital planning is being stress tested earlier. Capital planning assumptions are being challenged sooner in the investment cycle. Grid availability is a prime example. In several U.S. power markets, including PJM and parts of the Southeast, large energy users have encountered multi-year delays for new grid interconnections. Projects that penciled out on paper are being deferred or resized because infrastructure upgrades are now required up front, often at costs not anticipated when capital was initially approved. Energy procurement strategies are facing similar pressure. Volatility in natural gas prices over the past 2 years, combined with uncertainty around long-term renewable contract pricing, has led some companies to shorten power purchase agreement terms or diversify across multiple procurement mechanisms, rather than committing to a single long-term structure. The shift reflects concern over locking in assumptions that may not hold as markets continue to reprice risk. Operational strategies are feeling the pressure. Operational constraints are making uncertainty tangible. Manufacturing and logistics operators are increasingly factoring permitting timelines and grid reliability into siting decisions. In regions experiencing rapid data center growth, utilities have openly acknowledged strain on local transmission systems, forcing other commercial and industrial customers to rethink expansion plans or invest in on-site generation and storage earlier than planned. Facilities teams are also responding to regulatory uncertainty by prioritizing resilience investments, backup power, fuel flexibility, and load management over pure efficiency upgrades. This shift is evident in sectors such as healthcare and advanced manufacturing, where downtime risk now outweighs incremental efficiency gains when external conditions are unpredictable. Markets are repricing risk, not waiting for clarity. Financial markets are reinforcing these signals. Insurers are reassessing coverage terms for assets exposed to climate, water, or grid reliability risks, while lenders are increasingly asking borrowers to demonstrate how regulatory and infrastructure uncertainty is being managed. These questions are appearing earlier in financing discussions, effectively pulling sustainability and compliance considerations into core financial risk assessments. The rapid rise in electricity demand from AI and data intensive operations illustrates this dynamic. Even without finalized energy policy responses, utilities, investors, and corporate buyers are already adjusting expectations around power availability and cost. The market response is happening faster than formal regulatory alignment, leaving executives to manage exposure in the interim. What this means for executive decision making. Heightened sensitivity to regulatory and market uncertainty is reshaping how decisions are made, not just which decisions are made. Leaders are prioritizing optionality, phased investments, diversified sourcing, and contractual flexibility over singular bets. Governance discussions are increasingly focused on identifying which assumptions are most vulnerable if current conditions persist longer than expected. Organizations that recognize uncertainty as a structural feature of 2026, rather than a temporary disruption, are better positioned to adapt without stalling progress. Those that wait for clarity may find that markets, regulators, and infrastructure constraints have already moved ahead of them. In this environment, competitive advantage is less about predicting outcomes and more about building strategies that remain viable across a wider range of scenarios. That recalibration is already underway, and it is becoming a defining feature of executive decision-making this year. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.